Hey, welcome back. Today, we're stepping into the world of options trading. If you've heard terms like calls, puts, or strike prices and thought, that sounds like Wall Street gibberish, don't worry. We're breaking it down. This is Options Trading 101, your intro to calls and puts, strike prices, expiration dates, and premiums. By the end, you'll get what options are, how they work, and why people trade them. It's a bit more advanced than buying stocks, but it's also pretty exciting. Let's dive in. What are options? Calls and puts. First things first, what's an option? At its core, an option is a contract that gives you the right, but not the obligation, to buy or sell a stock at a set price within a certain time. It's like a coupon with rules. You don't own the stock itself. You're just betting on where its price might go. Options come in two flavors: calls and puts. Let's start with calls. A call option is your ticket to buy a stock at a specific price later. Imagine you're eyeing Tesla stock, trading at $200 today. You think it's going up. You buy a call option that lets you buy Tesla at $210 in the future. If Tesla rockets to $230, you can still buy it at $210. Score. You just made a profit without owning the stock outright. That's a call. You're betting the price rises. Now, puts are the opposite. A put option gives you the right to sell a stock at a set price. Say Tesla's at $200, but you're worried it'll crash. You buy a put option to sell it at $190. If Tesla drops to $170, you can still sell at $190. Nice safety net. Puts are your play when you think a stock's heading down. Here's the kicker. Each option controls 100 shares, not just one. So one Tesla call at $210 means you're set to buy 100 shares at $210 each, or $21,000 worth. But you don't pay that upfront. You pay a smaller fee, called the premium, which we'll get to later. Calls and puts are like tools. Calls for bulls who think up, puts for bears who think down. And if you're wrong, you can just let the option expire. No big deal. You're not forced to buy or sell. Strike prices and expiration dates. Okay, now let's talk about two key pieces of every option: the strike price and the expiration date. The strike price is the set price you can buy or sell the stock at. It's the target baked into the contract. For that, Tesla, call. $210 is the strike price. If it's a put, $190 is the strike. Think of it as the finish line. The stock price has to cross it in the right direction for you to win. Strike prices come in all sorts of levels. When you look at an options list called a chain on your trading app, you'll see strikes above and below the current price. Tesla's at $200. You might see strikes at $190, $195, $200, $205, $210, and so on. If the strike's close to the current price, like $200, it's at the money. Above it, like $210, it's out of the money for a call, or in the money for a put. Below it, like $190, it's the reverse. In the money means it's already profitable if you used it now. Out of the money means it's not there yet. Now, expiration dates are the clock on your option. Every contract has a deadline, maybe a week, a month, or even a year from now. After that date, the option's done, like an expired coupon. Short-term options, like ones expiring in a week, are cheaper but riskier. the stock has less time to move. Long-term ones, like a year out, cost more, but give you breathing room. So, when you buy an option, you pick both, a strike price and an expiration. Say, Tesla $210 call, expiring June 30th. If Tesla hits $220 by then, you're golden. If it's only $205, your call's worthless at expiration. You wouldn't buy at $210 when it's cheaper on the market. Timing and targets, that's the game. Premiums. Last up, premiums. The premium is what you pay to buy the option. It's the price of the contract itself. Think of it like a movie ticket. You pay upfront for the chance to see the show. For that Tesla 210 call, the premium might be $5 per share, or $500 total since it's 100 shares. That's way less than the $21,000 to buy the stock outright, which is why options are so tempting. What sets the premium? A few things. First, how close the strike is to the current price. A $200 strike call, when Tesla's at $200, is at the money and costs more than a $250 strike that's out of the money. Closer strikes have a better shot at paying off. Second, time. A June option costs less than a December one. More time means more chance for the stock to move. Third, volatility. If Tesla's wild, jumping $10 a day, premiums spike because big swings mean big potential. You can also sell options before they expire. If that $5 premium rises to $8 because Tesla climbs to $215, you could sell the contract for $800, $300 profit, no stock needed. But if Tesla stalls and the premium drops to $2, you're down $300 unless you hold to expiration. The premium's your risk. Lose it all if the option expires worthless, or cash in if it works out. Closing. And that's options trading 101. Quick recap: calls let you buy, puts let you sell, strike prices are your target, expiration date's your deadline, and premiums are what you pay to play. Options are a way to bet on stock moves with less cash up front, but they're risky. Timing's everything, and they can expire worthless. Still, they're a blast once you get the hang of it. Try paper trading, fake money, on an app to practice. What do you think? Ready to explore a call or put? Thanks for joining me. Catch you next time.